Hey everybody, welcome to Trading Capital's Daily Analysis video. I'm your head market analyst here, Curtis Scouten. Jumping into the charts on this November 3rd, 2022. Yet again, another wild price action day. Now, today we had a gap down on basically the S&P and many individual stocks as well. If we flip to the intraday chart, you can see this is where we closed yesterday and it gapped down this morning and you started to fade in the pre-market. Made a new low as the markets opened within the first basically half an hour, and then the market started to rally, recapture and flag sideways and trying to consolidate on this level of support. But needless to say, you did come up here and fill the technical gap on the intraday chart, but you did not fill that gap on the daily chart. You missed it by just about, a few pennies here or there, about 50 cents. So with that in mind, there is the potential that I do think you fill this on the daily chart. Considering you did fill it on the intraday but not on the daily, there is always the potential that you could trend lower. Now, one of the reasons you could trend lower is because you have to keep this in mind is that you have this massive daily gap over here. Down here, this wick did not happen. We keep touching on this in every video because it's an important level to keep your eye on. This is a technical level backed up by a short major reversal candle here and a big level of support in a completed pattern move. So the S&P is now trading along this downsloping trend line. You can see this is where you broke out and you actually did confirm a technical breakout, but you did not confirm above a key 50-day moving average, which is a lot of what funds and algos trade on. So the fact that you failed to confirm above that and you've actually now confirmed below the 50, this is pretty much turning into more of a bearish trend. And you can argue that you are at support, you're back to the breakout zone. But one of the reasons I'm very cautious about this breakout zone, and I don't think it's going to hold for much longer, you can see that we had the bounce today. But honestly, if you look at the weekly chart, right now, and there's still 2 days, basically tomorrow's trading still to go, but right now we still have a weekly engulfing candle that is potentially taking hold. You can see we made a new weekly high and now we're looking to make a new weekly low, pretty much negating that and engulfing that candle. That on a bigger time frame is actually very bearish, and considering it's basically 2 weeks worth of data that is almost comprised in just these 2 candles, that is, you have to respect that in the near term trend. If you take a look back at the daily, I still think we head back down to the 357 mark, but we'll just have to see how long it takes us to get there. Obviously, you have had a 3-bar move to the downside with pretty much a gap down, so arguably you can say that maybe you get a potential bounce off of this level. Maybe you fill this daily gap and flag sideways and then start rolling over, but time will tell. Obviously, today we received some other earnings in the market. You can see the market has fallen in the post-hour session, and that's on the back of the likes of PayPal falling. PayPal was down almost 12%. You did have Net, Cloudflare that fell sharply, down about 13%. Twilio got demolished. If we take a look at Team, flip to this chart, TEAM, that was down at the lows, 26%. Now you're looking at 19%. So these are tremendous moves to the downside that are occurring. You did have some strength in the likes of Square, so that company did do fairly well. Basically at the highs there, it was up almost 15-16%. Now it's settling in around double digit 11% there. So that is impressive, but nonetheless there is more sell side pressure in the markets, and you can clearly identify that through the S&P 500. So there is potentially going to be some day trade setups tomorrow with this extra volatility, and then it'll be really important to see how the remainder of this week shapes up. So basically what I want to touch on next is tomorrow is important because it's Friday, we get a weekly candle close. But let me take a look at the QQQ for a second. The QQQ is showing that relative weakness. I did trade the QQQ intraday today for myself, but nonetheless, the Qs did fill that technical gap, and you got an intraday bounce off of that level. That was a very good tradable level to do, and I think that we can do that on the S&P 500 as well. But considering the Qs have sliced through that same level that the S&P 500 is, just shows you the weakness in technology and these bigger mega cap tech companies. And it's really identifying the strength in the energy sector and more so the banking sector. And it's just the 2 indexes are starting to really diverge in a more noticeable technical pattern level. So Qs could arguably come down to this double bottom zone as the S&P fills its equivalent gap fill. So that's kind of what I'm expecting. The Qs have not completed its fully measured move down yet. That's at about 251.45, but considering you have a pretty strong reversal pivot here, this is a potential level to trade against in the near term by picking up swing trades. If you got that confirmation close below that, then obviously you could exit all your longs with a little bit of a stop loss there. So in terms of what I expect for the Qs, I do expect if we have a straight shot down into this level, you will get some sort of a bounce. But ultimately, I do expect this level to break at some point in time. I have priced in several of my videos that the Qs should get to this pre-COVID high by the end of the year. Many people are still hoping for a Christmas rally, this and that. But if you just look at this overall trend, we're having these mean reversion bounces and fears starting to set in. But as you get farther and farther down into the trend, people start to question it more in the sense of retail, and they start to look at their statements because the markets have been getting so demolished. And that's when sometimes panic starts to set in, and we'll just have to continue to monitor this. Yields are starting to soar much, much higher. We have been warning about a yield breakout and another dollar potential breakout. Basically, both are on confirmation. I want to flip to the 4-hour chart because we can see that we achieved our first upside target. Here was our first inverse head and shoulders. Here's your left shoulder. Let me just go on a smaller time frame. Here's your left shoulder, your head, and this is your right shoulder over here, which you broke out confirmed. The upside target was achieved at 112.50. We said that was target number 1. And just look at how you basically smashed through that upside target and retraced perfectly back to that target level that we identified in our previous video. So that is the power of knowing how to calculate these patterns, movements to the upside. But that was an epic level that we put on our charts to calculate. And the importance of this is that you've now fulfilled one of the inverse head and shoulders. So the short-term pattern is actually more bullish to the upside. And secondly, if you look, there's another inverse head and shoulder, a bigger one. So you have a left shoulder, your head, and then your right shoulder with your descending neckline sloping all the way down there. And it looked like you were breaking it. You know, you were teetering, you stayed above here, looking to close below it, but then you rallied back, made a new low, no, didn't confirm, rallied back, saved it. And then this epic move down on the FOMC PAL day was pretty amazing. I mean, to see the dollar fall like that, looking like it was going to be a failed pattern, and then it got bought back up in the blink of an eye is pretty spectacular and just shows you the insane volatility on markets. And this pattern is still technically intact, which you've confirmed and broken out. And the upside target we gave on that was all the way up here around this triple top, 113.95, 114 area. It'll probably hit the 114 level. But you are coming into some short-term resistance. You do have this upsloping trend line connecting 1, 2, 3, 4 major pivots, and this is your consolidation chop before breaking down. So that is going to be some resistance in the near term. But if this consolidates basically in this upper range above this key 112.50 level, that is going to be extremely bullish for the DXY, which should put additional pressure on the markets. And if you look at the yields are on a short-term breakout. If we look at the 2-year yield, I should say, keep in mind the 2-year yield is what the Fed uses and prices in as their expectations. Basically, this is where the Fed fund rate needs to be. The Fed fund rate is currently at 4% after yesterday's quarter basis point hike or 3/4 basis point hike. But you can see on the yields, look at this massive wick right into our beautiful measured move to the upside here. And the importance of this is that this is a fake print. This never actually happened. But this year, fake prints have been very, very accurate, and you certainly have to pay attention to it. So if we flip to the intraday chart, that fake wick, whoops, my apologies, that fake wick on the chart takes you up to 5.1%. So that is substantially higher from where we currently are, and you could maybe see somewhat of a blow off top if, you know, maybe the jobs data that comes out tomorrow is stronger than expected, which is going to push for yet again a more aggressive Fed. But that you're talking about an 8% move to the upside that is looking likely to occur based off of the fake prints that have occurred so far this year. But nonetheless, the importance of breaking past this pivot high, which is what the bond market priced in as peak Fed hawkishness, is now been broken. And if you close above this high tomorrow, you have confirmed a short-term breakout on yields, and the probabilities, I would say, of attaining this wick high goes up to about 80%. So just think about where assets are priced right now, and if interest rates are still expected in the short term to head higher, that should put pressure on the markets in a very difficult way, especially risk assets, which is why I guess a lot of risk assets are selling off. But you still see a divergence across the whole stock market and the bond market. And like I said, every time that has happened, you've played catch up to the downside for many stocks. And I think we're still going to see that. Right now, you're seeing many overcrowded trades into the value plays. The value plays generally go through these phases like Exxon. Yes, it's a company that's making massive money, but the fact that it got bought up so quickly today, with oil still declining, 1.5% and on the verge of a potential breakdown, I mean, that just shows you how overcrowded these trades are. And one thing I know about overcrowded trades and how the stock market works is you have funds basically playing a game of losing less. Some funds have to stay long in the stock market, and it's not about a matter of them being in cash. Some of them can't even sit in cash. They have to be invested. So it comes to a game of, even though they know the stock market is potentially and most likely going down, they have to be playing the game of losing less money. There's technology funds, there's energy funds, there's metal funds, there's all sorts of different funds out there, and each of them have their own mandates and criteria, and a lot of them have to be invested all the time, so they buy up quality stocks that, yes, are producing good cash flow and great earnings, but their valuations in the economic environment that we're heading into are not sustainable. And we tend to see this over and over and over again, and especially since I have oil priced in, that in the near term, I think we get a sharp move down to this 84.30. I do think we can see a big negation of this impulse move to the upside. I think oil is starting to look a little bit tired. You're starting to be trading in a wedge pattern at major resistance. Here you made a new low. Basically, you made a little bit of a high at resistance. You pulled back. You didn't make a new low, but you also didn't make a new high. So I still think that, considering oil and the economic demand is waning globally with a severely aggressive Fed, I still think that oil is going to at least see this downside target of 79 or retrace back down to this upsloping trend line. I think there's a bigger wedge pattern in play over here that oil can chop around in. I think this is going to be the range where basically we see oil flush back down and then maybe chop back up and then flush back down and chop back up, ultimately before making a bigger move in one of the directions. But I'll have to analyze that at a later date. So oil short-term target is around this 84.35 level. And then if we start getting some real downside momentum into next week, then I do think we can come test this significant 879 gap fill. I would love to see a straight shot in oil, potentially down to this level or this trend line, because that may pose a little bit of a buying opportunity for a 2 or 3 day bounce before it potentially rolls over. But let's take it day by day, and let's just see what else is happening in the energy market. Natural gas is having another down day. So this wild price action, up, down, reversal, down, down, gap up, all the way to the upside, reversal back down, basically reversal back up, reversal back down. This is insane volatility in the natural gas market. It's looking to me that it still technically is holding bullish consolidation above a key breakout trend line. So my thesis is still favoring an upside move. But this type of choppy, volatile reversal, in terms of a consolidation pattern, the shape of it, yes, technically is looking, but when you read the candle formations and understand that this type of volatility in a consolidation formation is not healthy, it's showing that no one's having confidence. There's new traders coming in, new traders coming out, new traders coming in, new traders coming out. And from my understanding and perspective and experience over the years, every time you see consolidation in this form where you had massive choppy reversals in every which way, it generally leads to a failed move. So I'm not ready to buy this long. We did make a little bit of a profit on our natural gas long trade, but I'm happy I'm out because we caught this 2-bar surge, and then everything in between there has been this volatile, wishy-washy type of trading. Let me take a look at the gold chart right now. So the gold chart, pretty disappointing for gold. It did make a new low, or sorry, it did not make a new low. I think it was the gold futures that made a new low. But nonetheless, gold is closing off of its low, so that is healthy to see at this point in time. But it is down on the day, down another 0.36%. Taking a look at silver, silver had an impressive reversal, actually finishing up on the day 1.32%. It was disappointing that the miners did not play catch up for silver, but what can you do about that just when there's a weak stock market? Bitcoin still bullishly consolidating over here. I would have expected Bitcoin to sell off a lot sharper based off of the yield movement, but I would have also expected the markets to continue to sell off, or at least some things shouldn't have had the rallies that it did. I mean, to simply see like a stock like Roku, I mean, when you get I think it was down at the lows here, yeah, what was it, 18%, and then you get a reversal and it almost goes positive on the day, just down 4.57. Like, that is spectacular, that type of movement. That drop, that pop, that is just an incredible, incredible level. And you can see, like, I was just too slow to get that trade off, but you can see why it bounced off of that technical level. Parallel channel, boom, at support in an oversold condition. So it's super interesting to see how some of these stocks, I mean, if you look at some of these other bloated names like Cat is having a superb reversal, but nonetheless, you did not take out this daily reversal signal yesterday, so I'm still optimistic about that. Gilead's another one. It just got bought up today on any sort of a strength, but again, these names are trading now at crazy lofty valuations in a scenario where global conditions are weakening. Even if they're value plays, you're at extended resistance at levels that you haven't seen in quite some time. So the odds of a pullback still to, I think, support here is very, very likely, which should net us a pretty decent profit on that trade. And it is still good to see that we have this beautiful reversal signal over here, this daily topping tail in play, still acting as resistance. That's our level to trade against, so we'll just have to keep that level in mind. And I still think I'm gonna hold this trade till the gap fill down here, because it's certainly one of those names that, yes, it's a safety play and it's a value play, but Gilead Sciences, you don't really see these types of moves often, or at least when you see them, they're not sustained. I mean, you've had these wishy-washy periods, again, sharp moves up, sharp moves down, but this type of move has been sharper than all of your most recent moves in quite some time, in years we're talking about. Like, this was a sharp move here, but ours was sharper over here. This was a sharp move over here, but again, the one we're experiencing today is much, much sharper in an environment where there is less liquidity and slowing and crushing demand from central banks. Let's take a look at, I'm just going to scroll through my alerts here, see if there's anything else I can touch base on. Basically, I don't think there's too much to cover. It's interesting to see the divergence between the longer end bonds and the short term, but nonetheless, the long term bonds basically still finished positive on the day. So just grinding up and up and up and up. And honestly, you do have resistance here, which is this yellow trend line. But you could still grind up on that trend line for quite a long time into this double top zone, which still would put additional pressure on the markets. But if for some reason you have a blow off top and somehow close above this yellow resistance line, that is going to be very, very bearish for stocks, because now it presumes that you're really resuming the actual significant uptrend of this move. And if we look at it on a larger time frame, the weekly, you can see the weekly, you were basically testing that level, closed below on the dailies, but now on a weekly chart, you're looking to recapture that upsloping trend, which took us from basically 2.51 to all the way to the high here at 4.3. So that is a steep trend to resume, but if it does recapture that on the longer and shorter time frames, then that you have to assume on a technical basis that is extremely bullish for yields and extremely bearish for the stock market. With that, I think I'm going to sum it up on today's video and leave it at that. Overall, the S&P 500 is showing better relative strength, but still weak. I still think there's a very, very probable chance that we can get a small, maybe intraday bounce. Perhaps we had it today. That could have been your intraday bounce, but perhaps we get a little bit of more consolidation before breaking lower. I do think we're going to break lower. Based off of the yields and where they are in comparison to how the market is, I anticipate if we have a strong day in yields tomorrow, up about 1%, and the dollar up maybe by 0.5%, I anticipate that we could see a move down of 3% in the spiders, or even 3.7 to come test this gap fill down here. So that's kind of my expectations. I would not be surprised if many people don't want to hold over the weekend. But now with like the Fed being extremely hawkish and the bond market pricing in the most hawkish Fed in 2022, so that's what we have to keep in mind. The bond market is pricing in the most hawkish Fed that we have seen in 2022, when not within a few days ago we heard Fed pause, Fed pivot, stock melt up, this, that, small caps leading, the divergence, blah, 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 blah. We weren't saying that, but mainstream media was. And that's why we have to do our own analysis and research, because we have skin in the game. I have my own skin in the game. This is, we don't take this lightly. We have to try to take every opportunity and advantage that we can. And that's all we can do at the end of the day. But overall, please give this video a big like down